Hey everyone, welcome to this explainer. Look, if you've been paying any attention to the markets lately, you know the end of Q2 2026 has been an absolute roller coaster, right? We're looking at this crazy landscape defined by market chaos, some pretty severe geopolitical whiplash, and yet, hidden underneath all that noise, there are some incredible alpha-generating opportunities. And by that, I mean investments that are actually beating the market average. So today, we're going to unpack exactly how specific macro data and geopolitical shocks collided this week, but more importantly, what you should actually take away from this shifting landscape. Let's get right into it. Okay, here's our roadmap for today. Number 1, macro shocks and inflation. Number 2, geopolitics and energy markets. 3, crypto, outflows and infrastructure. 4, an equity spotlight on AI infrastructure. And finally, number 5, the week ahead. All right, starting with Section 1, macro shocks and inflation. Let's dive right into the first major headwind that slammed into the markets this week, the persistent, really stubborn nature of U.S. inflation. 4.1%. That's the May PCE, or Personal Consumption Expenditures, headline inflation figure. And what's really wild here is that this is the highest level we've seen since all the way back in April 2023. Literally, the entire market is holding its breath right now, asking one critical question. Have we actually hit the inflation peak? Or is this elevated plateau just kind of our new reality? Let's break down the moving parts of that shock. So, May core PCE hit 3.4% year over year. In response to this, plus some recent hawkish Fed signals, meaning they're favoring higher interest rates to cool things down, Bank of America dramatically revised its forecast. Get this, they're now projecting not 1, not 2, but 3 rate hikes by year end, pushing the target to 4.25 to 4.50%. But honestly, the most fascinating ripple effect of this inflation wave, it came from Apple. They unexpectedly hiked prices across the board, Macs, iPads, the Vision Pro, you name it. And the reason is wild. It's a massive memory chip shortage caused by suppliers like Micron redirecting their chips to those highly lucrative AI data centers. So yeah, AI demand is quite literally stealing the chips out of your next iPad. And this perfectly illustrates a really harsh reality. We are now seeing the AI build-out's first visible consumer-level inflation consequence. The key takeaway here is that the massive premium being paid by these AI data centers is just completely crowding out consumer electronics. The downstream effect of this whole AI boom, it's showing up right on the price tag of your next laptop, which fundamentally alters the broader inflation narrative. It's not just about services and energy anymore, it's hitting consumer tech goods. Moving on to Section 2. Geopolitics and energy markets. Let's see how this all feeds into the global energy picture, where, man, geopolitical whiplash completely upended the market's brief moment of optimism. Just take a look at this rapid 3-day timeline. On June 17th, the US and Iran signed a memorandum of understanding. By June 19th, a renewed ceasefire between Israel and Hezbollah was announced. The markets kind of breathed a collective sigh of relief, right? But then, literally the next day, June 20th, Iran recloses the Strait of Hormuz, citing violations of the agreement. Now, the source material for this explainer was heavily skeptical about the durability of this peace deal from the jump, and as you can see, that skepticism was validated in real time, all within just 72 hours. And the market reaction was, frankly, violent. During that brief window of peace deal optimism, WTI crude oil bottomed out at $76 per barrel. But when the reality of the strait reclosure actually hit, crude bounced aggressively right back up to that $84 to $86 range. Now, the Source newsletter held firm on energy exchange-traded funds, like XLE and Devon Energy, throughout that initial price drop. By basically ignoring the sentiment-driven optimism and betting on the fragility of the geopolitical situation, that strategy ended up protecting capital and generating some really significant returns as oil surged back up. All right, Section 3, crypto, outflows and infrastructure. We're seeing a fascinating tug-of-war here. Severe pressure from rising interest rates on one side, battling against the quiet, massive growth of underlying blockchain tech on the other. You can see this divergence super clearly here. Bitcoin faced some massive macro headwinds, and during its absolute worst week of 2026. We're talking $1.79 billion in ETF outflows, dropping below $60,000. It's really struggling to compete in a world where risk-free cash might soon yield 4.5%. On the flip side, though, Solana actually gained 8%, pushing up to $72. Why? Micro tailwinds. There's been intense ecosystem activity, like a major Kraken exchange integration and a big strategic partnership with South Korea's KG Group. So it completely decoupled from Bitcoin's macro struggles. But, if you take a step back from those daily price charts, this is the number that actually matters, 589%. That is the staggering growth in on-chain tokenized assets since early 2025. Just let that sink in for a second. According to Binance Research, that 589% growth translates to $31 billion in tokenized assets. And we aren't just talking about digital art or meme coins here, guys. This is being driven by tokenized bonds, money market funds, and public equities. Traditional Wall Street titans, think BlackRock, Franklin Templeton, Citigroup, they aren't just watching from the sidelines anymore. They are actively building the rails. So while retail traders are sweating over Bitcoin's daily price swings, institutions are quietly migrating real-world assets onto blockchains like Ethereum and Solana. Basically, crypto is officially graduating from a speculative experiment straight into foundational institutional infrastructure. Okay, let's pivot to Section 4, Equity Spotlight, AI Infrastructure. We're going to bring this explainer down to the micro level now, shining a spotlight on two specific AI infrastructure equities that perfectly illustrate the source's overarching strategy, which is, essentially, finding value amidst the chaos. So consider this for a second. Why would a stock with massive AI power demand crash 18% in a single day? The company is Bloom Energy, and they went from a midweek peak of roughly $340 to just falling off a cliff on Friday. Bloom Energy dropped all the way down to $247 intraday on Friday. But here's the catch. It wasn't because of lost contracts or some failed product launch. It was triggered simply because a competitor, Fuel Cell Energy, got an analyst upgrade citing a valuation discount, so investors violently rotated out of Bloom. But, as the source material points out, this crash perfectly hit their target entry zone of 250 to 270. The underlying business thesis? The massive power demands for AI data centers, a 2.8 gigawatt deal with Oracle, a $5 billion Brookfield partnership. Yeah, literally none of that changed. Only the price changed, which basically opened up a prime window for the patient investor. Now let's look at another infrastructure play. Nokia. Yes, you heard me right, Nokia. You probably remember them for making those indestructible consumer brick phones that could survive a nuclear apocalypse. But the reality in 2026 is a radical AI transformation. They've actually secured a $1 billion investment from NVIDIA to build AI-integrated radio access networks. Their AI and cloud sales are already up 49% year over year, and they're perfectly positioned to dominate an optical networking market that's projected to grow 9 times larger by 2028. It's this heavily undervalued, vertically integrated play for the AI data center boom that the market is really just starting to wake up to. When you put these strategies together, the results are pretty striking. While the broader S&P 500 is up a modest 1.8% year-to-date, the source portfolio is up approximately 20%. That is a massive 18.2% of alpha generated. How do they do it? By navigating inflation, geopolitical war shocks, and tech volatility completely impartially. They leaned into energy when others assumed peace, they bought AI infrastructure on irrational dips, and they held strong defensive income positions. Which brings us to our final section. Number 5, the week ahead. So how exactly do we navigate the immediate future given all this ongoing chaos? Well, we have a highly compressed, high-stakes, holiday-shortened trading week coming up. On Tuesday, we get the ISM Manufacturing PMI, the Purchasing Managers Index, which is our first real look at how businesses are actually handling these energy price swings. But Wednesday is the main event. Fed Chair Warsh speaks in Portugal, and his tone is absolutely going to dictate global bond and equity markets. Then, Thursday brings the June jobs report, a full day early, and on Friday, the markets are closed for Independence Day. I want to leave you with this provocative question to chew on as these numbers roll in. Will Thursday's jobs report validate a resilient labor market and actually force the Fed into that brutal 3-hike reality Bank of America is predicting? Or will the data finally show the cracks necessary to pause rates and ignite a late summer rally? Keep your eyes on the data, stay patient, and remember that volatility almost always creates opportunity. Thanks so much for joining me on this explainer, and keep learning.